Hey, welcome to Fix and Flop. Today's episode, I'm here with the birthday boy,
Yes.
Stanley Din. And we're not going to say his age because I learned from an old school leader.
What is
He
it?
said, never tell people your age.
Really?
Yeah, he said just make a joke, lead them along, just avoid the question of your age because people will always try to put you down based upon your age.
I see.
So his advice to young leaders was never say your age, because he became a leader at 19 years old.
Really?
He's a world famous leader, and that was one of the things that his mentor taught him is just don't tell people your age. As long as they don't know, they won't put you in a box.
Okay,
So-
that makes sense.
So we're not going to say his age, but we will say that it's his birthday, which I just found out about a few minutes ago.
Mhm.
If I would have known better, I would have bought him a cigar or something, or we would have planned dinner. But we'll do it when I get back, because I'm leaving for Colorado tomorrow. But welcome to the Fix and Flop TV show.
You think we should do our own little fix or flop theme, Joseph?
Yeah, we can come up with our own.
Yeah,
little
like
thing, and then
fix.
you program it.
Yeah, program in there. Fix or flop. Something like Jeopardy. I don't know.
Not a bad idea. Not a bad idea. I just hope you're not singing it.
No.
So today's special cigar of the day is the Arganosa leaf. This is the rare leaf reserve. This one is about 4 years age, 4 years old. I don't know if you could really, I don't think it really comes in that clear right here, but this is the special cigar from Nicaragua, I believe Esteli. So this is the one we're going to be showing, and we're going to be trying. So
That's sick.
Let
me grab some of my cigars. I have one that's discontinued.
Oh, really?
Yeah.
Let's take a look at what he has here. Let's just continue. Let's get this here cut open, and let's let you guys hear it. Turn the volume up.
They don't sell these anymore, but I don't know if you've seen these. This is a 5-year-old cigar. Yeah, Royal Butera Vintage. I have never smoked this in my life, but it looks good, and I have another good one. Someone recommended to me in the cigar lounge. We got Perdomo Fresco. I know Perdomos are always consistent, right, Joseph? They're like one of the best on consistency-wise. And I have another starter one. Esteban, I don't know how to pronounce that. Carrera. You like this one? Huh? You like these? They're good.
There we go.
Yeah.
We got this one going. He goes to the people that are in foreclosure and he helps them out, because the sheriffs are going to show up at the house and put them out on the street, and it's going to be ugly. It's just not going to be good for them.
Yeah.
So that's what he does. And so, Stan, what did he ask you to do today?
He told me to look at some to help him knock on some doors. Josh, right? Yeah, he told me to knock on some doors, and he also showed me a list of all these foreclosed properties, and there's quite a bit of them, Joseph. I'm talking about in Fort Bend, in Harris County. There's 2-3 pages, and each page has like 10 or 20 different properties.
Yeah,
and I've seen one with I've seen some of our partners in there too. Like on the foreclosed properties, I've seen some of our partners in there.
Oh, the name of the banks?
Yeah, the name of our partners.
Really?
Yeah, I can name some of them, but it's crazy. Yeah.
Who?
Well, Penny Mac. I saw Penny Mac.
Really?
Yeah, one of our partners.
Oh, they're a big one. Well, they're not our loans because we don't do a lot.
Yeah.
I don't think we don't do a lot with Penny Mac, so can't blame us for that.
Yeah.
But Joe has a question. He says, "Is it always a rule to put down 20%? To put 20% down?"
No.
And it's not a rule. So let me just explain this situation with the 20%. So if you put down 20%, then you're not going to have the PMI. So PMI could be 150, 230, an extra, $150 to $200 for the PMI.
Mm-hmm.
All right. And if you don't have PMI, you're going to pay 150 less. Now that 150, 200, 230, 250 bucks, that money never goes to your principal. That's just, basically you're burning that money. It's private mortgage insurance. It's what the banks use to, I feel more comfortable holding my mic. So
okay.
It's what I'm a preacher, so I like to hold my mic, but it's what the banks use to insure themselves. So if they go belly up on the mortgage, the insurance will pay, and the insurance will help the loss with the bank.
Yeah.
So they make you pay it when you don't put 20% down. Why? Because if you're not putting down 20%, what that means is that you're leveraging all the bank's money, or a lot of the bank's money, and you don't have as much skin in the game. Which, if you don't have as much skin in the game, that means that it's easier for you to walk away, easier for you to default. So if you put down 20%, the bank says, hey, listen, he's putting some serious skin in the game. So we're going to, give him a better rate. He's going to have a better term.
Exactly.
He could waive his tax escrow, waive the insurance escrow. He could pay the tax insurance on himself. So monthly, you're not paying as much monthly. You can pay that on your own once a year. And so your monthly payment, the pressure on you for that much of payment is a lot less if you put down that 20%. And you're not paying. So a payment that might be $3,800 a month.
Right.
It's with 20% down, waiving escrows. That payment could be $2,100 a month, $1,900 a month. So it's a big difference. Makes it a lot more comfortable for you. And if you still want to pay an extra $200-$300 over every month in your payment, you're going to pay your house off, faster. 5, 4, 6 years faster, whatever. You're going to pay the house off faster. So, those are some of the benefits of putting down 20%. That's why it's good to put down 20%. Yeah. But let me ask a question. 20%, say that's $110,000. You could take $110,000 and put it in a 30-year bond or CD or something, right? You could put it in a bottle, throw it in the ocean, and it comes back in 30 years, so to speak, right? So what happens if you get a good business opportunity and you need 50 grand, 60 grand, 100 grand? What if XRP goes down to 75 cents a coin, right? Boy, yeah. And you want to buy some XRP? Well, you can't use that 120 grand, the 140 grand, that 90 grand, because that money has now been tied up in the CD or in the, in some long-term, some 30-year investment instrument.
Right.
A house is an investment instrument. So every dollar that you put into that investment instrument, it's harder to extract it. You have to apply for another loan, go through another paperwork, another, $6,000 to $12,000 in closing cost. So it's hard to get that money back out. So somebody who's just working a job and you live paycheck to paycheck, you're working a job, sure, put down as much as you can. Your payment will get lower. You'll eventually own the house debt cash free.
Right.
Someone like a lot of the customers I work with, they're doing businesses, they're buying franchises, they're fixing and flipping, they're buying houses. They could do a lot more with their capital than putting it in a 30-year security instrument. 30-year life policy or a 30-year CD or a 30-year, I don't even know if CDs go up to 30 years, but you know what I'm saying?
Yeah.
I guess you can, right? A 30-year bond or CD. So you're putting all this money into a security instrument that is going to be hard for you to access if you need to make a quick deal. Now, most Americans are not wheeling and dealing. So if that's the case, put that money down into your home, lower your payment, get a little bit lower interest rate possibly. And that's going to be the best thing, if that makes sense.
Right.
But if you're someone that's doing business, you're buying and selling cars, you're buying and selling anything, businesses, franchises, you need money, you need some cash to be in and out. Maybe it's not going to be advantage for you to put down 20% to tie up all that money. Unless you have a lot more. I mean, if you got a lot more, yeah, put down whatever. If you have a lot of cash. But if that 20% down equals the majority of your savings or all of your savings, do you really want to do that? If I had just 20% down, I wouldn't put it down because I want to have a cushion, right? It's good to have a 6-month cushion. If anything happens to you for 6 months, if you can't work, you're not going to get a check for 6 months, you can still make your payments, pay the light bill, take care of your family, buy groceries for 6 months. So if you're going to deplete 6 months of savings by putting down that down payment, why put that pressure on yourself?
Right.
Put the 3% down, pay a little bit more monthly, but you're keeping that cushion.
Yeah, because there's other costs and fees associated with it as well. We're talking about insurance, upfront insurance costs, home insurance, HOAs, everything. There's a lot of other costs included. So you want that cushion.
Yeah, I mean, yeah, I understand. Now those other costs, those other costs that you're talking about, they could be included in your monthly payment, you know, as far as the tax and the insurance and all that, by doing an escrow, or you can do it once a year. So I think a good question, if I was watching this podcast, I would ask somebody, I would say, should I waive my escrows or not? If you waive your escrows, it's less pressure on you to pay. Like I said, that payment might be $3,800 a month. If you waive your escrows, it might be $1,900 a month or $2,500, $2,400 a month, right? So it's a lot less pressure to monthly have to pay so much if your cash flow is thin monthly, right? So should I waive the escrows? I don't encourage anyone to waive the escrows unless they're good at saving money, because you're going to get a tax bill at the end of the year for $8,000, $10,000, $12,000, $15,000, depending on the tax rate where you live. You're going to get a tax bill, and if you don't pay your taxes, your house can be taken from you. And there's what's called tax auctions. At a tax auction, I just posted a tax auction today to a friend of mine, Alex, one of our staff. I posted him this tax auction. A tax auction is where people who haven't paid their property tax for a couple of years, they basically lose the right to their house. So what the city will do is they'll auction off their houses to investors. So you could be sleeping in your bed one day, some guy knocks on your door and says, "Hey, bub, you haven't paid your taxes in 3 years, and I just bought your house. I just bought your $500,000 house for $150,000."
That's terrifying. That's the last thing you want to.
I have a friend that does that. One of my customers in Florida, I'm not going to say his name to protect his anonymity, but he buys properties from tax auctions, and he has all kinds of houses. He bought a house at a tax auction for like $350,000. He put in $100,000. And now the house is worth $750,000.
That's crazy. So wait,
the
deed just transferred?
Yeah, the city takes it.
Wow.
Because this person didn't pay the taxes for 3 years. And I was told that in Florida, he's in Tampa, that people are like hawks. The day that is your last possibility to pay your taxes, they are down in the city watching your house, watching your tax record like hawks.
That's terrifying.
And the day that you miss that last payment to keep that house, they are at the county offering money to pay to take your house.
Oh my God.
And there's people doing that every single day all across America. So if you're not good at saving money, I'm good at spending money. So for me, just put it in an escrow. My house is in an escrow. I pay my tax, my insurance, principal, interest, everything in one payment every month. That's my payment I got to make, and I'm under that gun.
Way less headache than.
Sure. I could pay $1,700 a month versus $2,800 a month. It's a lot less stressful, but I'm going to get a fat bill at the end of the year for $10,000. Right.
That's true.
So those are the pros and the cons. Now, a lot of my customers are Indian people, they're Asian people, they're good with saving money. And I typically just say, hey, just waive your escrows. Your payment's going to be $1,900 a month. It's not bad at all. Just waive your escrows. At the end of the year, they get their tax bill and they have the money. Boom, they pay.
They got the money. They have the cash.
Yeah. And a lot of them don't want to put 20% down because they're buying franchises. They own cell phone stores, donut shops, gas stations, these type of things. So they rather just put down the bare minimum, 3%, whatever, 5%,
right,
and pay that little PMI, because with all that extra cash, they could buy their 5th, their 7th, their 8th, their 9th franchise.
Exactly. I remember one of the clients actually put 50% down.
Yeah, I got one today.
Yeah, 50% down.
When I called you today, when you called me or whenever I was in a meeting, it's another one of my customers who I've done several loans for.
Right.
He's buying a house in Dallas. He's putting down 50%.
50%. Wow.
Yeah. But it's a fix and flip.
Fix and flip.
So he's putting down 50% and he's going to flip it and get his money back right away.
I see.
So he don't mind putting up all that money this time because he's going to flip it right away.
Wow. Okay.
It's like $250 and he's putting $50,000 in repairs. He's going to sell it for $380.
Yeah. I have a client right now. She has no choice but to go FHA and do 10% down because her credit score is so low. But we can do it. It is 100% possible.
Yeah. So if you're if you're kind of like under 600 or 580, you have to put down 10%.
And this is with a FHA.
Yeah. Now, let me ask you a question. FHA are most of the houses that are in foreclosure right now in this area. So our friend wants to send some addresses to Stanley to go knock on the door and say, hey, listen, we want to bail you out of that house. We're going to give you $8,000, $10,000. The sheriffs are going to be here in 30 days. We're going to give you 10, 15 grand right now to just, you can go get you an apartment and forget about all this and just let it run its course. We're going to take care of you. Don't worry. Here's some money. Go. And, but let me ask you a question. If somebody puts down 3% or they do down payment assistance, which is a program we have where you put down no money, and somebody puts down 10%, which one is more likely to start missing payments? The one who didn't put down nothing.
Yeah.
There's no risk, So the person who doesn't put down anything, they don't have any, as much risk to walk away.
That makes sense.
So, and that's how the bank looks at it, right? So some people always ask about the rates, and I always explain this to people. Interest rates are all about the risk.
Mm-hmm.
The less risk for the bank, the lower the rate they can give you. So if you have great credit, big down payment, all of those things, and it's less risk because you have a lot of money in it. You're not going to walk away from it. Your credit's good. You have a good history, so it'll give you a lower rate. If your credit's bad, you're going to have a higher rate because you're higher risk. If you put less money down, you're going to have higher rate. Why? Because it's higher risk. So the pricing is all laid out based upon the risk of the loan. And so I try and people help understand that. They said, what if I put more money down? What if I put less money down? Well, I said, well, the less you put down, the more the risk for the borrower, for the lender.
Mm-hmm.
And therefore is going to be a higher rate.
Yep.
If you put down 35%, 40%, you're going to get a really great rate.
Mm-hmm.
If you do a 15-year loan, your rate's going to be very low. Like
right.
15-year loans are doing like 5.5, 5.1 right now, where a 30-year is 6.5 because you're going to pay it off fast in a shorter term. It's less risk for
right.
the bank. So it's a better rate.
And there are some people that have low credit scores, right? But they're able to buy down their rate. So even if they do have a bad, let's say a 550 credit score, that's borderline, by the way. A lot of banks don't accept anything under like 560. Under 560s.
Well, UWM don't take anything under, I think, 630.
Yeah, 630, right?
Yeah.
So, but if they have a lot of cash, they can still buy down that rate. So, one of my clients, 7%, 7.5% at their rate, but they can buy it down to 6.5, right? So it's all about the risk. Yeah, you're right, Joseph. It's all about the risk.
Yeah. So you could buy it down, whether it's high credit or low credit. Someone with an 800 score could buy down the rate too.
Yeah, 800, they can buy down the rate. But
someone with the 500 score could buy down the rate.
Mm-hmm.
You could always buy down the rate.
Mm-hmm. Yeah. Does anyone have any questions? Any other more questions, Joe?
Yeah, these are definitely good questions.
Yeah.
So, is it always a rule to put down 20%? The answer is no. It's not a rule. There is some benefit to it if you have some extra money laying around.
Mm-hmm.
If you don't, I wouldn't put yourself under that pressure. I keep a little cushion, and I would put down the minimum.
Yeah.
Now there's not much of a rate change between 3%, 5%, 10%, depending on the loan program. So to me, if you're not gonna, I would say like, if you're gonna put down if you can put down 3%. And you can't put down 5%, there's no reason to put down 6, 7, 8, or 9 because there's no rate change. At 10%, you might get an incentive. But then there's no reason to put 11, 12, 13, 14, 15, 16, 17, 18, 19% because you don't get that price incentive,
Right.
So, but if you hit the 20%, then you get another pricing incentive.
Mm-hmm.
That means that there's an incentive of a lower rate to put down more money. But that don't happen at 11, 12, 13, 14, 15. It happens at these certain buckets.
Yeah.
There's 3% a bucket, 5% a bucket, 10% a bucket.
Right.
20% is a bucket, right?
Mm-hmm.
And then there's also investment loans are 20%, 35% down, 30% down. There's one bank, Chinese bank, 45% down, no questions asked. No assets, no income.
No
nothing.
way.
45% down though.
45% down, but that's really powerful for some big investors.
Yeah. So let's see here. Advice for first-time home buyers as far as loan programs. Yeah, well, there is a couple of
There's a lot. Yeah.
loan programs for first-time home buyers. Fannie Mae has one called Home some. There's like Home Ready, Home One.
Yeah, Home Ready, Home One.
There's a couple of these. Home
there's
Possible.
Home Possible.
Home Possible is another one. See, these
Yeah.
are all Fannie and Freddie Mac, programs.
And they're all like they all have different requirements with them too, different credit scores. And I know that one of them actually gives you a gift, right? Correct. Some of our lenders for first-time home buyers, they get a gift depending on where the house is, where the property is. They get a $4,500 gift cash towards closing costs.
Well, there's Home Ready.
Mhm.
Okay, and then there's Home Possible.
Mhm.
And they all sound so similar that it's actually hard to remember them.
Yeah.
Like, was it, Home Ready, Home Ready, Home Ready, Home Possible, Home this, it's just, they sound so similar that it's hard to memorize, right? So I always have to look it up. But there is Home Ready, there's Home One. There's Home One and Home Ready. And the important thing is not memorizing these terms. We could always look it up. The important thing is kind of knowing that there are some programs out there that can get you certain things. He mentioned one where there's like you get $4,500 back.
Yep.
I have seen that before. There's one where you get $2,500 back. That's the most recent one that I've seen. And some of these programs require you to live in a certain zip code or move into a certain zip code, and your income has to be 80% of the average of that neighborhood.
Yeah.
So if the average income of the neighborhood is $100,000 per household, you have to make $80,000 or less.
Yeah. This is just an example number, by the way.
Yeah. That 100,000 is an example. So, and that's just, there's a lot of neighborhoods around 100,000 household. So you got to make 80%. So you got to make 80,000.
Yeah.
So this is a very common number. $100,000 is the average income of a lot of neighborhoods, total combined income. And if you're making 80,000,
you can still,
but you're trying to get a house that is like 450,000, well, you're really not going to get approved for a house worth 450,000 with $80,000 a year. So I find that a lot of people can't fit that program. This program really is for people to buy in a not so nice neighborhood, a cheaper house, because they're limited to making 80% of other people.
I see.
And so basically you're trying to move in a neighborhood that's really hard for you to move into financially, and they see you're struggling. You're only making 80%. Everyone's making 100 grand. You're only making 80,000. And they see that and they say, hey, listen, we're going to help you out. We're going to give you $4,500. We're going to give you $2,500. These type of things.
So definitely do research.
Or we're going to give you a lower rate. And and they could do research, but it's they're trying to find a needle in the haystack. Because the average person doesn't know. Even loan officers don't know all the differences between Home Ready, Home One, Home Possible, home this, home that. It's really confusing. It's hard to navigate. And that's what the whole thing was in the meltdown and the crash that happened in 2008, was that people were getting into these products they didn't really understand. So the best thing to do is talk to a loan officer that has experience, that's knowledgeable, ask them to check on these programs, see what you can get. And if they don't know, tell them to do some research. I heard it on the Fix or Flop podcast. I heard Joey talking about it.
Yes, please.
I was watching the podcast. He said there's programs where you could get some money back, whatever, get lower rate for first-time home buyers. And they'll be forced to call the banks and ask the questions. They'll be forced to educate themselves. But you got to kind of push them, because most people don't really know all these things, because there's so many different programs. Exactly. They all sound the same. And they all have these small details about how much you make and what's the zip code you live in. And certain zip codes are eligible. Other zip codes are not eligible. And then there's another program, which is the Home One program. That one doesn't care about your AMI, and that one doesn't care what neighborhood you're living in. And that one you could put down just 3% and you have a low rate. That's the Home One. I know the Home One because that one I have more people that qualify for the Home One.
Yep.
So that's 3% down, no income restrictions, condos, single family homes, and the credit scores are pretty flexible with that. You don't have to have super high credit. So I'm familiar with the Home One. That's Freddie Mac's. I'm more familiar with that one. I tried to do one, the Home Possible, with $4,500 for one of the Vietnamese clients, and they didn't qualify because they made too much money.
I see.
The salary was too high or something like that. So
I had a client that was able to get the home possible, the 4,500 one.
Oh yeah.
Queen.
Oh, you got it for her.
Yeah, Queen.
Oh,
Yeah,
great.
that was
Great.
the one.
Yeah, that's
Queen.
a family member too, right?
Yeah, family member.
And what did they get $4,500?
Yeah, they got 4,500 for towards closing costs because they were in that area demographic.
Well, they should have referred you a bunch of people because you did a lot of work for them.
They did. They're trying. They're trying.
Oh, they're trying.
But no one's buying a house right now.
In your family.
In my family.
Yeah.
But
so this is all to answer Joe's question about first-time home buyers and loan programs. Those are some of the programs: Home One, Home Ready, Home Possible. Those are all different Freddie Mac, and Fannie Mae programs.
Yeah.
Another thing for first-time home buyers is down payment assistance. We have a down payment assistance programs, and the city has down payment assistance programs. Some of those you have to take classes and do different things for. We have a program where you don't have to take a class or do anything for it. It's a down payment assistance program, and you get a good rate with that. And you could, all you have to have is your closing cost.
Yep.
And as I was telling Joe earlier today, some people will they'll get money back from the seller to pay for the closing cost, and get the DPA program. And with that, they could kind of come into the house with little or no money down.
That's amazing. That's a really good.
I've done closings for somebody. I think it was like $75.
Wow.
They came to closing with just $75.
That is insane.
They had to have 2 months in savings. So they had to have 2 months of the payment in their savings account for the approval.
Wow.
But all the money down they had to pay was $75.
That's crazy.
And to get that money in the bank to get the approval, they sold gold coins. They sold their DVD player. They went around their house and sold everything to the pawn shop to put the money in the bank to show they have 2 months reserves. Got the house and went back and got all their stuff back.
Wow.
Took the money back and bought their stuff back. So that was in Florida. So where there's a will, there's a way.
When there's a will, there's a way.
There's a will, there is a way.
There is.
So a lot of these the people that have been in default are these FHA loans, which were riskier in the first place. And so this creates now a good opportunity for people like Josh or anyone that wants to work in this market is get these foreclosure lists. And if you want a foreclosure list, we can connect you with Josh. He might partner with you. He can send you some addresses. You can go out there, talk to the owners. If they agree to meet with him, he'll come meet with them, close the deal, and pay you a commission.
It's going to be a legwork. It's going to be a lot of legwork, though.
Yeah. You gotta definitely. Now I was imagining that he's walking around in the Houston sun, 110 degrees. That's what I was imagining, and knocking on every single door. But he's like, no. I just give you the address. You just drive up there and knock on the door and talk to him. So I said, okay, well I could do that,
But yeah, you gotta be really good at speaking. I feel like that type of job, you have to be really. You can't take anything personally. They will get some people will get mad at you. Or maybe even just shun you off, shun your way, close the door on you.
You don't know what's going on in the person's life, too.
Yeah, that's true.
Remember the one deal he told us about where the husband had got their babysitter pregnant?
Oh, my gosh. Yes,
remember
that one.
So the husband, you could watch this on our earlier podcast with Josh. The husband got another girl pregnant, so he was taking the money that he should pay for the mortgage, and he was sending it to this teenage girl who was now the mother of his newborn.
Yeah, that's insane.
And of course, that was friction on the marriage, and he lost his house. So you might be coming across, oftentimes when you're looking at these foreclosure lists, you're knocking on doors, you're talking to people that are going through some crisis. So they might get upset seemingly with you, and it might not be that they're upset with you. It's just that they're going through a hard time, and you have to communicate with them that you're here to help them.
Yeah.
And you can't get up, you take it personal if they answer the door mean, swearing, whatever. You have to stay in your zone. You have to understand that you're here to help them, and you just got to get past the emotion, the stress, the trauma, the emotional attachment. Some people are so emotional. Well, we've seen this in the hurricanes, right? You're from Houston.
Yeah.
I'm not from Houston, but you could probably tell me how many people were warned to leave during Hurricane Harvey and these type of things,
Yeah.
and refused to leave.
I mean, look at the California fires. Remember the California fires? That's a really great example. Some people just didn't want to leave. They actually just stayed while their house was burning down.
Many people have died in fires and hurricanes, disobeying direct advice from the government to leave their house because of emotional attachment. You know, a house is the biggest investment that a person will make in their
That's true.
life.
Yeah, that's true.
So there's a lot of emotional attachment. So now you're knocking on the door and you got to deal with all that emotional attachment, personal trauma, and all these things. So, but you're offering them a solution. You're there to help them.
Mm-hmm.
So you have to kind of be able to navigate through all that emotions and the attachment to the home. And you have to help them understand reality is in 3 weeks, the sheriffs are coming. You're going to be out on the street. My company is here to help people in your situation. That's what we do. We help people out. Would you be willing to sit down and talk about 2 or 3 options that we have that could get you in a nice place, stable and safe, while you work to rebuild your credit and rebuild your life? And that's the challenge. If you could do that and get that appointment and help them out, you know, that's where you make the money.
Exactly.
You know, you make the money by helping people. And unfortunately, a lot of people will just, they're praying for an answer. It's like that story about the person who was in the flood and he was on the roof of his house and the whole neighborhood was flooding. And a boat came. I said, get on the boat. We're here to save you. We're with the National Coast Guard. And they say, no, God's going to send me some help. And so the boat leaves. Then a helicopter comes and they drop down the ladder and they're yelling with the big, intercom. Get on the plane, grab the rope. And they said, no, God's going to help me.
Yeah.
Well, then the person drowns and he dies. And when he gets to heaven, he said, God, I asked you to help me. And God said, I did. I sent you a boat and a helicopter, dummy.
Facts.
And that's the real life situation that people often find themselves in. They don't want to accept the help because they're thinking that it's going to be some kind of check in the mail.
Mm-hmm.
And sometimes you have to help them understand, I am that check in the mail. I am that helicopter. I am that Coast Guard. God sent me. I'm here to help you.
Yep.
And we're going to do the best that we can. And that's basically the principle behind wholesaling. Are there people in wholesaling that aren't that ethical and want to bleed people dry? I'm sure there are, right? There are definitely.
100%, yeah.
But obviously, that's not you, and you have to let them communicate your compassion and your genuine concern, and offer them real solutions. And so Josh's company has a couple ways to do that, and I told them, if I have, I'm leaving to Colorado, I don't have time to do that. But right now on the market in Houston, there are a lot of foreclosures, especially these FHA homes. These people need a way out. If they don't have a way out, and here's the problem. The reason why we can't help them as mortgage brokers, we can't just refinance them and help them out, because a mortgage late is one of the worst things to have on your credit. If you have one mortgage late on your credit, it's like having leprosy. Nobody wants to touch it.
Sheesh. And how would you go about recovering from that? I'm so curious. Is there any?
The only way to recover from a mortgage late is wait 12 months.
12 months. No credit repair can even fix this.
And so if you're back now on your mortgage, you haven't paid 1-2 months, you not only got to catch up, but then you have to make your payments on time for the next 12 months.
I see.
And then 12 months of clean payments, still a lot of people won't touch you. Because a lot of banks want 24 months of clean history.
I see. I think I heard this from somewhere. Your credit score is not how much money you borrow or anything. It's just how well are you able to pay consistently.
Yeah.
Yeah. And if you don't use the money, let's say you don't take any payments, you don't have any credit, like your credit's, you don't borrow money at all, right? That score is actually going to go down too, right? That's what I heard. If you don't borrow any money.
Yeah, I have a guy that has zero credit. He's 35, maybe 36.
It's because he doesn't.
He has no score. He's a white American guy. And he has no score because his dad pays his cell phone. His dad bought him his truck. He lives at home.
Yeah.
Nothing's ever been in his name, and he has zero score. And now he's 35 years old, getting married. He wants us to help him get a house, but he has no score.
Mm-hmm.
So he has no debt. That's a good thing. He has no debt, right, Dave Ramsey's? But because he's not proven he can manage credit, he can't get the loan to buy the house.
Exactly.
So having debt is not a bad thing, but managing debt well and managing debt in a way that is good for you is different than just the term having debt. Having debt is not necessarily a bad word, but proving that you can manage debt, leveraging debt, using debt to your advantage. For example, if I borrow $100,000 to make $50,000, and it takes me 4 months to make that $50,000 with that debt, and I make my payments on time. So yeah, I got debt in order to do a deal. I made $50,000 on it, and I made payments, good payments, and then paid it off in full in a few months. That was using debt to my advantage. That was a good way to manage debt. It's called leveraging. So not all debt is bad debt. Something that someone pointed out today, though, is that a lot of people, they're using their debt to go to restaurants and groceries, to buy their groceries. And they're using their debt just to survive. That's not healthy.
That's not healthy at all.
Obviously, if you're going to use debt, you want to use it because you're leveraging debt for a purpose that's bringing, more value to your life.
It's crazy. There's actually apps, like applications that help you pay off your credit card debt for a monthly fee.
Wow.
Yeah, like they look at your credit history, they look at your debts, and they're like, hey, we can help you pay it off. Yeah, so this assistance for helping people pay off their debt by adding more debt. Does that make sense?
Yeah. Well, it's like the payday loan thing. Those things are those payday loan things are horrible. People call me all the time. Hey, would you like to borrow a couple $1,000s? Could you use a couple $1,000s for Christmas money? Could you use a couple $1,000s for vacation?
Insane.
Yeah, because I pay my bills on time, they're trying to get me to borrow more money. And it's someone says, hey, would you like to? You're approved for $5,000, $8,000
to buy a flat screen
and
TV.
these are reputable companies that call me up. I know them.
Okay.
They're good, real companies.
Mm-hmm.
And I'm like, oh yeah, well, an extra $8,000 that would be nice, but I'm fine because it's just a trap.
Yeah, it's just
they're trying to trap you, right?
Trying to make money.
Exactly.
That's for sure.
So, anyways, I think that's good. We've been on for an hour, right? And I got to pack, and it's your birthday, right? So it's 8:00, so we got to get going. But we thank you guys for hanging out with us. I hope you got some value out of this. If you did get value out of the topics that we shared today, in regards to first-time home buyers, how the credit system works, the different type of loan programs for home buyers, and all these things, leveraging debt, and how much should you put down, these type of things. If you got any value out of any of those things, we ask you to like and share. If you can like, share, and subscribe. So next time we come on, we try to come on once a week. And next time we come on, you can get an alert and know and watch the show. So, Stanley, you want to say anything?
No, that's pretty much it for me. Have a safe night, guys. Yeah.
All right, guys. Thank you for watching. This is Fix or Flop with birthday boy Stanley Din and Joe Castillo.